Assalamualaikum. Today me and my group will present of the topic company analysis. First of all, I as the first presenter will present about what is company analysis. Company analysis is a process carried out by investor to evaluate securities, collecting info related to the company profile, products and service, as well as profitability. It also refers as fundamental analysis. The company analysis incorporates basic info about the company, like the mission statement and operation and the goal and values. During the process of company analysis, an investor also considers the company history, focusing on events which have contributed in shaping in the company. Also, the company analysis looks into the goods and services offered by the company. If the company is involved in manufacturing activities, the analysis studies the product produced by the company and also analyze the demand and quality of these products. Next is part for an investor to evaluate the strength of the company. Okay, it has 5 parts. One of them is the competitive position of the company, profit margin and earning of the company, composition and growth in sales, the company capital structure, and lastly is the company asset mix. Next is financial statement. What is financial statement? Financial statement or financial report are formal record of the financial activities and position of a business, person or other entity. There are 3 types of financial statement, which is balance sheet, income statement, and statement of cash flow. Lastly is financial ratio. A financial ratio or accounting ratio is a relative magnitude of two selected numerical values taken from an enterprise financial statement. There are 5 types of financial ratio. It is regulatory ratio, activity ratio, leverage ratio, profitability ratio, and lastly market ratio. Okay, that's it. I will pass to Daniel Shaikal for explain about definition financial statement.
Thank you to the previous presenter. Assalamualaikum. My name is Muhammad Daniel Shaikal bin Faris, and today I will explain about financial statements, which is balance sheet, income statements, and statement of cash flows. Okay, now I will explain about what is balance sheet. Balance sheet is a financial statement that reports the company asset, liability, and shareholders' equity in a specific period of time and provide a basis for computing rate of returns and evaluating its capital structure. Balance sheet is a summary of the firm's asset, liability, and ownership position at a single point of time. To balance the balance sheet, the total of assets must be equal to the liabilities and equities. An income statement is a financial statement that shows you the company income and expenditure. It provides a summary of the operating result of the firm. It is also show whether the company is making profit or loss at a given period. The income statement is also known as a profit or loss statement. An income statement helps the business owner to decide whether they can generate profit by increasing revenues or by decreasing the costs or both of it. Furthermore, income statement indicates how successful the firm using their asset listed on the balance sheet. It is also show the effectiveness of the strategy that the business set at the beginning of a financial period. The business owner can refer to this document to see if the strategy that they have set have paid off. Based on their analysis, they can come up with the best solution to generate more profit. Okay, now I will explain about statement of cash flows. What is statement of cash flows? Okay, statement of cash flow is a financial statement that summarizes the amount of cash entering and leaving the company. Okay, this statement put together items from both balance sheet and the income statement to show how the company obtained its cash and how it used its valuable resources. The statement of cash flow measures how well a company managed its cash position, meaning that how well the company generates cash to pay its debts, obligations, and fund its operating expenses. This statement is divided into 3 parts, which is cash flow from operating, cash flow from investing, and cash flow from financing. The most important part is cash flow from operating activities. That's all from me, and I will pass to the next presenter to continue. Thank you.
Thank you to the previous presenter. My name is Siti Hajar and I will continue with the presentation by explaining on the financial ratios. Firstly, financial ratios are useful indicators of a firm performance or financial situation. Therefore, it can help us to analyze a company performance over time compared to the industry average and even predict future bankruptcy of the company. But how can we calculate these financial ratios? It is by calculating the information provided from the financial statement. Financial ratio can also be classified according to the information provided from the company's annual report. Furthermore, financial ratio can be classified into liquidity ratio, activity ratio, leverage ratio, profitability ratio, and market ratio. Moving on, the purpose of financial ratio is to assist the decision maker to develop their plans and strategies that will keep the firm in line towards maximizing owners' wealth. It is by assessing the periodic operating result and financial status of the firm. Financial ratio also shows relationship among the financial statement extracted from the balance sheet or from the profit and loss statement. Lastly, it is also a way to evaluate a company performance by comparing the historical data or industry average. How do they evaluate the company performance? It is by using trend analysis and comparative analysis. Trend analysis is a time series approach to measure the firm financial situation over time, whether it is declining or improving. For example, comparing the finance ratio in the year 2020 and 2019. Secondly, comparative analysis or industry standard are a cross-sectional approach that measure the firm performance to the industry average or other companies within the same time frame. Thank you. That is all from me. I will pass to the next presenter.
Hi, Assalamualaikum. My name is Akmal Asna. So today I will present about advantages of financial ratio. There are 4 advantages of financial ratio. First, meaningful comparisons. Financial ratio provide a standardized method with which to compare companies and industries. Ratio go beyond the numbers to reveal how good a company is at making a profit, finding the business, growing through sales rather than that, and a wide range of other factors. Second, reveal trends in an industry analysis. Usually, industry creating benchmarks against which the performance of all industry can be measured. Then, small businesses can use industry benchmark to create organizational strategy. Next, stock evaluation. Ratio can help investor and analysts to evaluate and communicate the strengths and weaknesses of an individual company or industries. Lastly, planning and performance. Ratio can provide guidance to entrepreneurs when creating business plan or preparing presentation for lender and investors. That's all. Thank you. I will pass the presentation for the next presenter.
Assalamualaikum and hi, my name is Anis Nashita binti Syardi. As the last presenter, I will explain about the limitation or disadvantage of financial ratios. First, financial ratios only based on historical. Since financial statements take considerable effort to prepare and review, they are always at least somewhat outdated, especially for the firms that publish key data only once at the beginning of each year. The ratio may be based on data that is no longer relevant. Moreover, financial ratio cannot totally dependable on interpretation. It can be quite difficult to ascertain the reason for the result of a ratio. For example, a current ratio of 2:1 might appear to be excellent until you realize that the company just sold a large amount of its stock to bolster its cash position. A more detailed analysis might reveal that the current ratio will only temporarily be at that level and will probably decline in the near future. Furthermore, financial ratio doesn't consider the impact of market conditions on business performance. For instance, an increase in the company's outstanding debt receivables during an economic boom cycle, when sales increase will be considered bad compared to a recessionary period. Next, financial ratio also doesn't consider the impact of price rise, which is inflation. If an increase in sales is purely on account of inflation, revenues of the business will appear to have increased over the previous year when in fact the revenues would have to remain constant in the real terms. For example, if the inflation rate was 100% in 1 year, sales would appear to have doubled over the preceding year, when in fact sales did not change at all. Last but not least, financial ratios not standardized for all industry. Different business operating in different industry, which is difficult to interpret based on financial ratio. Financial ratio are not the same across the industry, and it is difficult to compare companies based purely on their financial ratio. For example, a company in the trading business may have a current ratio of 3:1, which might appear to be excellent compared to a company in real estate with a current ratio of 1:1, as the financial ratio doesn't take into consideration the particular dynamic of the business and industry to which the companies relate to. That's all from me and my group members. Thank you for watching and listening to our video. I hope this video can help you in your study.